I think the markets have gotten to a really interesting point right now because on the one hand, we are forming what I've been writing about an ending diagonal kind of setup, and it's gone on for weeks despite various indications to be completely opposite from various indicators that I've discussed over this time. And that we are sitting ahead of an event, and most events have tended to be more positive than negative. Really makes you wonder what's going to happen from here, while the pattern is still developing and not yet confirmed to the downside. So it's a very interesting point as to what we're going to get from here on, whether it will be a spike up and then down, or whether it's going to lose its momentum right here. Though as I've discussed, if you see the breadth, there's really not so much momentum going around. Now there are several other factors that have developed over this time. I've discussed last week the dollar rally, and it's gotten even stronger on Friday. You can see it across those currency pairs that I discussed, except for the euro, which still moved up. So that was a surprise factor because everything from the Australian dollar, Canadian dollar, the SGD, all of them moved lower against the dollar, but the euro continued to hold up completely on the opposite direction. So it may be another intermarket divergence sort of misleading factor that we need to keep looking out for. The other interesting thing which has come up on the global map, and it caused a minor sell-off one day sometime last month, was the jump in yields in the US market, and the day that happened, after that it bottomed as a 5-wave decline occurred, and I put that nail across. And now what you have is, after several days of trying to bounce back, yesterday the treasury bonds again dipped very close to the point where that panic had come in. It appears to have almost gone unnoticed, at least by equity markets, but if it falls a little more, it would have broken that low. And then I think at that point, everyone's going to notice that US bond yields are heading higher, and that could create its own other short-term panic as the risks of the slowing down of US back of austerity grow. So that market is clearly showing that bond yields could head higher. A slight dip down on US bond prices could give you that risk. So you have these two risks hanging above. One is from the risk of higher rates in the US itself. Second, a US dollar rally. Third, you have commodities falling off, at least not crude, but gold, silver, and copper. All three of them showing declining trends pretty clearly now. Crude has a sell indication, but it's diverging in terms of price and trend, so it might just take a couple of more days before you get a confirmation from there. And most equities still continue to edge higher, not really confirming to these indications as yet. But because these risks are standing out, one needs to really be careful as to the downside risks that will suddenly show up as many of these trends mature, and at some point that leads to selling. So that's something that's going to be on the watch out, and that's we're getting a lot of warnings, both domestic indicators and global ones that are saying something could falter over here. And in any case, we had the rising wedge multi-month pattern on the US markets, and the S&P's upper line has moved up to closer around 1520, so it's still around 1.5% away from that target. And the pace at which it's heading up, 5-6 points a day, it could take its own time to complete, or it could just truncate at some point of time. So we're very close to even that point on the US equity market. So these are all the things that we're going to be watching out for. In short, everything continues to say that there's a near-term risk of a further reaction. Most stocks have reacted, just at the front end. Equity indices in India have not, and several global markets continue to edge higher, giving you different indications. But most asset price indicators, currencies, and yields are actually giving some kind of warning sign right now. That's all in this video update for me. Thank you.